Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
So I think the consumer, though, is slowing. We're seeing that trade down from steak to hamburger already take place. And you're seeing, more importantly, the retailers are responding. They're cutting prices, right? So you're seeing it across in products and services. That said, I think it's important to remember that the Fed is not focused on 2024. They are focused on their own calendar, which is the easing cycle, which they already told us is going to take 2.5 years.
The consumer is holding up well and is not falling off a cliff as some analysts had feared. You know, the economy was very strong in the second half of last year, and the big debate in the first half of 2024 was, were we seeing a sharp slowdown in the economy or a moderation into more modest, sustainable growth?
We haven't had a major iPhone upgrade cycle since iPhone 12. And now that there is a sense that there's enough new functionality and uses for the phone that we will have an upgrade cycle, which could last for a year or two, that warrants this excitement around the stock.
We got 1 hour to go until the market close. So let's take a look at the major averages today. Being driven once again by some economic data a little more favorable, namely retail sales coming in pretty well above estimates, particularly if you back out gasoline and autos. We saw an increase of 0.8%. Now, futures and swaps pricing in a 100% chance that the rate cut is coming in September. And that in turn seems to be fueling some of the action that we're seeing in stocks today.
Yeah, no, it's interesting because, you know, Julie, we've gotten kind of used to this drumbeat of sort of softer than expected economic data today. And to your point, one, the IMF comes out and says, you know what? U.S. economy is going to grow 2.6% this year, and that was a tick down from their prior forecast. But I think a lot of investors probably thought, you know what, decent, and certainly look around the rest of the other parts of the world, that sounds pretty good. And then to your point, June retail sales come in better than expected, and maybe that gave people a bit more confidence about where the consumer's at right now.
And that if the Fed is cutting, it's not because things are falling off a cliff, perhaps, but more because they're normalizing.
And if and when they do cut, the sense that they're not cutting into an economy that's rolling over.
Exactly.
Right,
So that's definitely evidenced by the Dow today, which is the outperformer. It's up more than 700 points, 1.8%, another record for the Dow today, well above 40,000, approaching 41,000. In fact, the S&P 500 also on track to close at a record today. That wasn't the case yesterday, remember? So this would be the 38th straight record that we have seen thus far this year. And the NASDAQ also not on track to close at a record today, but it is gaining in today's session, although it's gaining the least of the major averages here. It's up just about 1/10%. Something else I noticed today, with these rate cut hopes coming back to the fore.
Another pop, I know.
Russell 2000 just keeps outperforming the large caps. It's up another 3% today. But there's a couple other things I want to check on, Josh. First of all, since the Dow is where we're seeing strength today, I wanted to look at the Dow and what we're seeing. And of course, banks are a part of the gains that we're seeing today. Also, something like United Health earnings. So earnings
really
are part of the story. We're going to get more into that later. But it seems like there's just this confluence of factors today that's driving the Dow between earnings, those rate cut expectations, and the economic data also.
I thought, and just going back, I thought what you saw in the small caps is just really interesting. In fact, I said interesting, then remember Bespoke's Paul Hickey corrected me. He said, no, Josh, the move you're seeing is fascinating.
Fascinating.
It's fascinating.
There you go.
And sort of, you know, you can sort of understand it. Listen, if you think, I guess, Julie, that, you know, you're going to bet the Fed's cutting and you're going to bet that Jay Powell has stuck the soft landing, why not move into the small caps? Now, the question becoming, you know, what does it actually mean for the broader market?
Yes, it's true. One more thing I just want to touch on here today, looking at the leaderboard, this is one of Jared Blickery's favorites. All the way up on the left there, you see the XHB, which is the home builders. Home builders in particular are doing really well today, even though the National Association of Home Builders Confidence Index came out, still showed weakness, but that's gaining on these rate cut hopes and the economic data. Regional banks, the KRE, also doing pretty well today.
And by the way, you could actually think of some of those home builders too. They actually would kind of roughly fall into that pint-sized cap category as well. All right, let's get more on this. Joining us now for more on the Fed and the latest market moves, Amy Kong, Corient partner. Amy, actually, I just want to start right there. You heard Julie and I talking. You look at the indexes showing green today, but small caps, Amy, that is a subject of a lot of conversation. They are working again. What does it tell you, Amy, just about the broader market here?
Yeah, Josh, it's a great question, and I appreciate that. I think we're basically seeing another episode where investors are more risk on, hopeful that the Fed is going to cut this year. And in essence, we've seen that episode play out a few times, starting from the beginning of the second quarter, where investors have been really just wavering back and forth in terms of what the Fed is likely to do and how soon they'll do it. Whether or not this is a sustainable rally, that's something that I would be continuing to watch. Essentially, you've got small caps and some of the cyclicals performing better in recent days. But I think the Fed continues to be super data dependent. And while the Fed is likely not going to cut in July, we're talking about September, there's still 2 more inflation data points to come between now and then. And if any of those data points start to either plateau or reverse to any degree, I think the Fed starts to hesitate a little bit again. So whether, again, this is a sustainable rally, I would say just be mindful, watch it carefully, and not necessarily conclude that this is more sustainable than not.
So this is a really interesting point because the market now seems to be, okay, September it is. And your message is, let's not get ahead of ourselves, right? That it's not a certainty, even though the market is pricing it in that way.
I think that's a fair statement, Julie. And all this year we've seen that happen, not so much in the first quarter, but in the second quarter. The market's focus has, again, just been back and forth, whether it's on monetary policy. It was offset by a decent earnings season. And now as we're getting closer to whatever the Fed said more recently about not having to wait for the data points to hit 2%, maybe they'll cut a little bit sooner than that. You've got also a lot of other central banks already cutting rates around the globe. There's pressure on the Fed, and so again, that momentum is shifting more to monetary policy. I would also add too, as we're heading closer and closer to November, there's a third dynamic, which is the political season, and Americans, investors, obviously this is a very sensitive issue for many. There likely to be more volatility, from my perspective, in terms of where the market's direction will likely go over the next couple of months.
It's interesting, Amy, though, because we've had strategists come on who almost suggest they think September's a lock at this point. So if the market didn't get that cut in September, how do you think the market reacts?
It really depends on what the Fed messaging is. So when you saw the Fed readjust their summary of expectations and the projections going into next year, while they did reduce the number of rate cuts for 2024, what they did was they added that rate cut, if you would, or the number of rate cuts, while they reduced it this year, they added it onto 2025. And so from my perspective, the market kind of took that as a neutralizer or a non-event, because it's not necessarily saying they're not going to cut. It's just push down the way a little bit. And from that standpoint, the market didn't see too much of that. So going back to your question, when it comes to September, if the messaging is, hey, the data is still kind of fluctuating back and forth, we're on a path to where we think the goal would be, I think the markets would be okay with that to a degree. But I think the messaging, if it starts to turn the other way, where they're saying, oh, hold off, the data is becoming a lot hotter than what we're thinking, maybe we won't cut, or any of that type of commentary, the markets, in my personal opinion, could, again, turn the other way around.
I mean, and it's been so long since we've had that kind of a turn, at least on a single day, right? As you pointed out in your notes to us, it's been a year since we've seen a drop of 2% in a single session, which is unusual to see that span of time.
Oh, yeah.
So the Fed is, and the timing of the rate cut, one of the potential triggers. What are the other sort of danger signs or risks that you're looking for in the market right now?
I appreciate that question, Julia, and it's spot on when we think about valuations for the market. To your comment, the S&P has not retreated more than 2% in now over a year. I'm thinking it could be as much as 18 months. I haven't counted, but in general, it's been a very long streak. And when you think about the streak being this long, it's natural to think that perhaps a breather is likely to happen, or some kind of pullback to an extent, and we haven't gotten there yet. So now that we're entering this next earnings season and we're starting to see some of the bellwethers report, while some of those data points have been reasonable, we're going to hit tech, which is the heart of earnings season in the next couple of weeks, and then retail towards the back end. That could be one of the factors that decides, is the market going to pull back a little bit? You've got the S&P now trading at 20 times forward earnings. It's at a 10-year high. Not to say that we're looking for any kind of major pullback, but any kind of soft pullback just to reset expectations, in my opinion, is normal. Is
and would
actually
you
healthy.
add there if that happens?
Depending on where the pullbacks are, we're very mindful. I'm very mindful of concentration risk. So to the extent that some of the tech companies, which have done very well and have reported decent, especially the ones that are exposed to AI, exceptional results, if they start to pull back, you want to just be careful, just knowing that they have just done so well. They make up, as a group of 10, make up close to a third of the S&P, maybe not so much there, but looking for those other 490 companies that have not broken out yet. Maybe there's opportunity there. We're starting to see that this month. It's nice to see the equal weighted S&P index actually outperform for a long time, for once in a long time. That's great. We really need to see that happen more and more sustainable in order to really call this rally a sustainable rally.
Amy, thanks so much for coming in. Appreciate it. Well, we're just getting started here on Market Domination. Coming up, shares of Charles Schwab are sinking as the company plans to downsize, while Bank of America and Morgan Stanley are jumping on their latest earnings. We'll check in on the banking industry on the other side. Plus, Netflix is set to report results this Thursday. We'll be joined by an analyst later in the hour to preview what to expect from the streaming giant. Stick around, we've got much more Market Domination still to come.
The CME Fed Watch Tool now fully pricing in a cut in September, but some economists are now calling for a cut at the meeting later this month. But be careful what you wish for. At least that's according to our next guest. Joining us now is Stephen Risciuto, Mizuho, U.S. Chief Economist. Stephen, it's good to see you. Actually, I want to start, Stephen, with the economic news we got this morning. I just curious to get your take there. That June retail sales data we got, Stephen, is better than expected. I'm curious to hear what you made of that report and just more broadly where you think the American consumer is at right now.
Yeah, I think the retail sales number today, moves the series back to what you would expect given where the payroll employment numbers are, the income generation coming off of that, and the industrial production coming off of that. This is an economy that is still very, very resilient. The U.S. consumer is resilient. And although we like to talk about, the labor market is becoming more balanced, we're going from an exceptionally tight labor market condition of 3.7% to 4.1% unemployment. And that's still below what we economists typically believe is the neutral rate of unemployment. So it's still a tight labor market. The fact that the consumer is, resilient as a result of that should not be a surprise.
Stephen, I believe you were one of the folks coming into this year who said maybe we won't get any rate cuts when the rest of the market was quite certain that we would get many. I'm curious where you're at now, given what we heard from Jay Powell the other day, given the latest inflation readings, and given the retail sales numbers today.
Yeah, you're asking a really good question. I mean, I think the point here is we've been data dependent all along. We came into the year suggesting that there would be a transition in the economy from above trend growth to trend growth, and that along with that, we'd see some modest easing up of the labor market conditions. But inflation would get stuck at around the 3% level as opposed to the 2% level. And largely, that's still the case. The economy looks as if it's going to average 2% over the first half of the year, which is trend. It's not below trend. It looks as if the labor market has eased up a bit, but really not a lot. In addition to that, inflation is in this 2.6 area, and given the benchmarking or the base effects, we're likely to move higher as the balance of the year progresses. So you've kind of got the best period of economic information to say we should be cutting rates, but the reality is you haven't quite hit that test yet of where you should be to really cut rates. And the market wants to adjust so aggressively that it's creating a financial market environment that I think is providing extra stimulus to the economy, and that could very well preclude a rate cut.
I'm interested, Stephen, too. Your thoughts generally on the labor market. Obviously, we've seen signs of cooling there, Stephen. But beyond cooling, are you seeing any signals that concern you, worry you?
I mean, I don't see anything that's worrying. Yeah, there has been some cooling, but we have to ask yourself a question. Is the cooling really real? And that's an unfortunate question we have to ask ourselves. When you look at the rise in the unemployment rate, we've seen two things happen. We've seen the participation rate rise, and we've seen the household employment numbers really stagnate. Meanwhile, the payroll employment numbers are growing at a very healthy 200 to 225,000 a month pace. Now, eventually, the household employment numbers always catch up to the payroll numbers. And when that happens, we could very well be looking at a drop back in the unemployment rate to lower levels, or we could sit at this level for a very long period of time. The other reason why I question whether or not the labor market has really become easy is because the number of people being laid off, whether it's the continuing claims numbers, the unemployment rate claims numbers, or whether it's the unemployed numbers themselves from the payroll employment, from the household-based survey, people are not getting laid off. And that's what shows you what a labor market is easing up. If we're in a situation where people just aren't getting hired, according to the household survey, that could simply be because we're not finding it hard to find qualified workers in those areas that are covered. Maybe that's not an indication that there really is slack developing in the labor market. That's indication of a problem within the labor market.
We have been talking a lot with market participants about the upcoming presidential election, the effect it could have on the markets. I'm curious how you're thinking about it and its potential effect on the economy, or are you kind of waiting until we get closer to start to frame that out?
Well, no, I mean, I think what you're looking at for either individual, you're looking at additional fiscal stimulus. And the economy is already dealing with a $2 trillion budget deficit. So we're likely to be dealing with a $2.5 to $3 trillion budget deficit. And I'm afraid that kind of budget deficit is going to require higher long-term interest rates. And our risk has been all along that the yield curve eventually steepens from the long end, not that it steepens from the front end, the way everyone wants to believe and has been betting all year that it would happen. And the reality is long-term rates are today, even today, after this recent rally, still higher than they were when we began the year by almost 50 basis points.
Stephen, great to have you on the show today. Appreciate all that insight.
Cheers.
Let's take a look now at some of the trending tickers on Yahoo Finance today. First up, we've got United Health Group. I mentioned it at the top because it's one of those Dow components that is helping boost that index today. The shares are up 6%, reversing course after a mixed second quarter report left investors concerned about higher costs in the wake of a cyber attack on one of its affiliates, Change Healthcare. Now, when you're talking about the health insurance companies, you're talking about not just their earnings per share. You want to talk about their medical loss ratio. What percentage of premiums goes out
Very
the door
important metric,
to cover costs? And that number was not quite as good as had been anticipated, but it looks like investors were sort of putting it down to those one-time costs associated with the cyber attack. And that's one of the reasons that they're giving United a bit of a pass.
Yeah, I reached out to Ben Hendricks over at RBC. He covers this name, get his take. Ben told his clients, he put it like this, and I think it kind of speaks to what you just said, Julie. He said, listen, solid adjusted EPS beat. He called this an atypically kind of noisy quarter, but says we believe the added headwinds were well signaled by management and should serve as a clearing event for investors looking ahead to 2025. Looks like just based on the reaction, investors agree with that.
Yeah, and other insurers were also moving higher on those numbers. In addition to that, the CFO said that the medical loss ratio should be at the upper end of its projected range, so that perhaps giving a little bit of reason for optimism.
All right, our next trending ticker, let's check out this one. Adidas company raising its full year earnings guidance after a better than expected second quarter. Its second upgrade, by the way, this year. Weaker sales from rival Nike, one of the factors helping boost the German footwear brand. So they did raise their annual profit target, second time in 3 months, Julie. What is driving this? It sounds like fans like those classics, but also more sales from its stockpile of Yeezy footwear too.
Yeah, and we're showing there the German shares. The U.S. shares, which were open when this came out, are seeing a little bit of a boost here. The ADRs, they're not super highly traded in terms of volume, but they do reflect some optimism from this target. And the company has been raising the targets. Some of this has to do with just the hotness of Sambas right now that, I don't know about other parts of the country, but when you walk around New York City, you're seeing an awful lot of those triple stripes. Sambas, Gazelles, some of their models are sort of
the classics.
The classics are back. The stock, by the way, is up more than 20% year to date. Nike shares, by contrast, are down more than 30%. So some of it just, sometimes just has to do with what's cool for whatever drives that.
Yeah.
I'm not smart enough to know. All right. Finally, let's take a look at Charles Schwab. That stock is sinking today after a mixed earnings report, and the CEO warning the company is going to have to downsize in order to maintain profitability. And when we're talking about downsizing here, shrinking the lines of business, it sounds like, could be part of this. The company did see new brokerage accounts in the quarter up to 985,000. That is an increase, but it's short of what analysts had been anticipating. And Schwab has sort of never necessarily gotten its groove totally back after we had the sort of SVB blow up and the regional banking concerns, because this was one of the companies that seemed to be infected by that.
Yeah, I mean, you looked through the metrics and you were calling out the right ones, Julie. I mean, adjusted, earnings per share did beat consensus, but other metrics not as good. Total net new assets, new brokerage accounts fell short there, and you can see the reaction. We're down about 10% in today's trade.
Yes. Let's talk about some other financials as well today. The bigger ones, Bank of America, Morgan Stanley, adding to the upbeat trend in investment banking, specifically both banks seeing big gains in that business. A similar tone from peers JP Morgan, Citi, and Wells Fargo. Yet with Fed rate cut expectations still unfolding, there are challenges ahead peeking through for big banks. CFRA Director of Equity Research, Ken Leon, is joining us now to discuss. Ken, normally we've been starting sort of big picture here, but I want to zoom right in on Bank of America because you downgraded that stock to a sell today in the wake of these earnings, even though the shares have been doing pretty well. Their highest, in fact, in about 2 years. They gave a forecast for net interest income that was above some estimates. What didn't you like in these B of A results?
Yeah, it's great to be with you. So I think Bank of America's, it's a 15-year high. So that's pretty good. Rates, outlook, and the economy are good. So all the financial stocks, large bank stocks are doing great. But for Bank of America, the performance in the second quarter was like the first quarter. We had flat, no growth in loans, no growth in deposits, no growth in credit card income, which is significant, and we saw a decline in net interest income. So a lot of the storyline on the call, which I think analysts kind of liked, was that even though you had negative net interest income, which is 54% of your total revenue, it's going to get better in the second half of this year because in the second quarter, deposits declined for consumers who had to pay taxes. So it's kind of weird to see the stock up, but I think that's more to the macro call on financials and banks. I thought Bank of America underperformed compared to JP Morgan, Goldman Sachs, or Morgan Stanley today.
And how could you do move to a sell there, Ken. When you were talking to your clients, how could you be wrong, Ken? What are the upside risks to that call?
Well, there's always respect. We're all students of the market. So what we do, of course, on any recommendation is make a judgment call based on our insights, our views of the fundamentals, and of course, our experience. So, CFRA is the largest independent research firm in the world, and we make independent calls, and that speaks to your question.
You mentioned Morgan Stanley and its numbers today. Saw some strength in investment banking. That's what we saw for many of these banks, particularly in the capital markets business as well. How sustainable do you think deal volumes are going to be going into the second half of the year, particularly with the election coming up?
Sure, it's a great question. And we hit the trough for investment banking fees last year, probably in July. We're still at just the beginning of a rebound. But saying that, the first quarter, first half of this year had record results for debt underwriting, but equity underwriting and IPOs are still in really the early innings of recovery. And keep in mind, there's two major sources for deals. One is obviously corporates, but the one that has not been participating as it tries to figure out valuation with rates is financial sponsors. That's the alt industry that I cover, which includes companies like Blackstone, KKR, Apollo, and many others. So that's $1.2 trillion in their investment cycle that has to be monetized. Otherwise, their wealthy, limited partners around the world from the Mideast or Singapore, wherever, aren't going to go into new funds. So that is a major opportunity for Morgan Stanley, Goldman Sachs, and each of these firms also are participating in the alt investments as well.
Ken, I'm curious too, it is an election year, politics are front and center. Are you getting questions from clients about how you think this election could play out and what it could mean for the sector you cover?
Yeah, so, my good colleague for many years, Sam Stovall, our equity strategist, is all over this, along we have four great research teams. One is Washington Analysis. They have actually reversed and see a higher probability of Trump getting elected, but things can change. Generally, in answering this question, my view is watch the Fed and watch Jay Powell. Jay Powell, as you all know, was interviewed at the Economics Club and was leaning to a Fed rate cut in September, maybe another one later this year. I think that matters more than us playing the hand of who's going to be in the White House and who controls Congress. But of course, Sam Stovall has all that data going back to 1940.
Let's get your view on that rate cut then, when it ever does happen. On balance,
Sure.
Is it better for the banks when the Fed begins to cut rates?
I love the question because the answer is it depends. So in research that we publish, I have a chart I've used for years that looks at the mechanics of how rates impacts net interest income, which we did speak about, or loan volume. So the direct answer is, so long as we have a stable or strong U.S. economy in particular, then if rates are coming down 50 basis points, but the volume book of loans grows, doesn't decline, then it's kind of, to me, going to a rate cut regime is neutral. It's not negative.
But I guess that latter part is the important part. Is the loan book declining, right? What are we seeing among consumers in terms of that loan demand right now?
Sure. So we look at all the loan components quarterly for every bank, and then also look at delinquencies and provisions for loan losses. And so far, to my point, I underscore a strong U.S. economy. We are seeing increases in transaction volume and loan activity. No, it's mostly the upper income or the baby boomers that are driving this economy, that are mostly have portfolios in the market. Those who are suffering out there in the U.S. are lower income or middle class, where it's hard to pay their bills with higher health care and food costs.
Ken, thanks so much for joining the show today.
Thank you.
Coming up, former President Trump has named J.D. Vance as his running mate for the 2024 election, but what kind of market impact would Vance have should the pair win? We're going to discuss on the other side when market domination continues.
Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will impact your bottom line long after the presidential polls have closed.
Our bottom line, it's still the economy, people.
We've got team coverage from New York to Los Angeles, but we start right here in Washington, D.C.
You can catch Capital Gains on all your favorite podcasts and streaming platforms. You can't afford to miss it.
Ether building on gains as the crypto market may be looking at another win this year. Spot Ether ETFs could reportedly launch as early as next week, according to Reuters. With more on the crypto action, let's get to Yahoo Finance's Jared Bleeker. We've been waiting for this for a little while. The drumbeat has been going on.
Oh, we have. And I mean, we waited a long time for those spot Bitcoin ETFs. And I think it took 10 years, if memory serves. But anyway, next Tuesday, mark your calendar, July 23rd. That should be the date when we get, I believe it's 7 or 8 brand new spot Ether ETFs. And this would complement the existing spot Bitcoin ETFs. And there are already Ether ETFs that use futures. So we have those as well. But I thought it'd be interesting to plot the price action, just kind of remind people what happened with Bitcoin, and maybe something similar happens. Let's just check out the one-year chart, because it was last September, October that Bitcoin really started coming alive with the rumors about these spot Bitcoin ETFs. Then when they came in the middle of January, that's that red dot there, we got a little bit of a sell-off, and that was pretty anticipated. People said, sell the news event. They took a little profits, but then it was back off to the races. And after about a month, we found ourselves kind of building the current trading range. And that has occurred over the last few months. And we've dipped under it a couple times here, most recently just a few days ago, but we've managed to bounce back. And that is very constructive. And all of this, I should say, is going on, or was going on, in the midst of the German authorities releasing 50,000 Bitcoins that had been in custody. So there were a lot of bearish forces, but nevertheless, Bitcoin prices survived. They managed to rally. Here's Ether. Now, this is also a one-year chart, and you can see the consolidation area is quite a bit bigger here for Ether. It's more volatile, but similar to Bitcoin, it has rallied off the bottom end of the range. Now it's right smack dab in the middle. So what might happen next Tuesday? Are we going to get a sell the news event? Well, probably too hard to figure. I would say it's a little bit too early to say. However, things get really interesting if Ether shoots back up to about 4,000, right in the middle of its current trading range. Doesn't really matter too much what it does. But if it goes back up to 4,000, 4,200, that's where things get interesting. And then you got to ask yourself, well, what's the next catalyst? Wall Street has been tripping all over itself to get behind Bitcoin. Only recently, Larry Fink, head of BlackRock, one of the biggest ETF providers in the world, walked back some of his very harsh statements of Bitcoin that he made 5 years ago. So Wall Street is behind this. The money's there. You just need those flows. And we've seen the ETF flows from investors. We just haven't seen them from investor 401ks just yet. That's kind of a critical component. Jim Bianco of Bianco Research has been all over that. But again, at least investors can look forward to another crypto date in the near future.
All right, Jared, thank you. Now let's get to some calls of the day. B of A Securities lowering its price target on Warner Brothers Discovery from 14 to 12. Reiterates its buy rating on the stock. The note citing that exploring strategic options for WBD would create more shareholder value. So interesting note, Julie, they do reiterate buy. They do lower their target to 12. And they did that, by the way, because given what they call unrelenting secular headwinds, decline in pay TV subs, challenging advertising environment. And they go on to tell their clients that, in our view, the current composition as a consolidated public company, it's not working, Julie. It's just not working.
It's not working.
And at current levels, we argue that exploring strategic alternatives, such as asset sales, restructuring, and/or mergers, would create more shareholder value versus this status quo.
Yeah, I mean, this is not a shocking view that it's not working, right? We've seen WBD it hasn't performed that well versus what perhaps there were hopes that it would do. It's down 30% just this year, and so perhaps not surprising here. But the question is, what would all of that look like? I mean, there has been some chatter this year that maybe there's going to be some more deals, some more remaking of the various streaming companies. They don't really opine on what that would happen. They get into a little bit like whether they're going to lose NBA broadcast rights, what effect that's going to have. Maybe they would sell the whole company, maybe they would merge with a broadcast network. But they don't seem to mention suitors necessarily. They just talk about the different sort of variations on the theme here of them breaking up.
Compelling assortment of assets is how they put it, Julie. And
for whom?
And the current valuation is undemanding.
Yes.
Yes.
Well, we'll see what happens.
All right.
All right, meanwhile, TD Cowen is outlining the risks and upside in markets following Trump's pick of J.D. Vance as his running mate, the firm taking a look specifically at crypto, financials, and housing. And what I thought was interesting about this note is the analyst here sort of acknowledges, and it's Jarrett Seaberg, by the way, over at TD Cowen. He says, normally we assign limited significance to the selection of a vice presidential candidate. He says, doesn't usually change significantly how people change their vote. But he says, yes, we believe Donald Trump's selection of J.D. Vance may be the exception. He talks about how Vance represents the more populist wing of the GOP, and that means that maybe he'll have a little bit more influence. They talk about specific examples here. He's a sponsor of the Credit Card Competition Act. That's the one that could be potentially negative for Visa and MasterCard. He has been more resistant to M&A than others in the party as well, including bank M&A, which he talks about here specifically, but also tech M&A is something that he's actually been complimentary of Lena Khan,
Very
which
much
is
so.
quite
Rare.
rare.
Doing a pretty good job.
Yes,
he has
exactly.
said. Yeah. His relationship with tech is going to be really interesting to follow because, as you said, he comes from the populist wing of the party. That's not a wing, Julie, that has a lot of good things usually to say about big tech, I think we can say. So that's interesting. On the other hand, though, the flip side of the coin, Vance worked as a venture capitalist, and he knows Silicon Valley. He knows all those players. He knows Thiel. He knows David Sachs. We recently had, venture investor Joe Laziel on the program, thinks very highly of Vance. So how that relationship play out exactly is going to be really fun to watch.
Is he going to, anger those buddies of his if he does indeed?
If you're a venture investor, you put money to work in companies that you wouldn't mind having big tech maybe make a play for.
Yeah, maybe not. All right, we are going to take a quick break here. Coming up, Netflix is reporting its results later this week. We've got a preview of everything investors are looking out for next on Market Domination. Big moves for Elon Musk. The billionaire announcing on X that he plans to move the headquarters of both the social media network and X, that is, and SpaceX to Texas from California. Musk saying that X will move to Austin, while SpaceX will now be based in Starbase, Texas. In his posts, Musk citing crime rates and recent California laws for the move. It's unclear, particularly in the case of SpaceX, which has big operations in California, whether he's just going to re-domicile it and still have operations there, or also move most of his workers there. That's not clear.
Yeah. So Elon's been in the news a lot. So we got going all in on Texas, all in on Trump.
Yeah.
You saw a journal headline. He's committing around what was it, $45 million a month to this new pro-Trump super PAC. Although we should note Elon Musk
He
took to
pushed back
X,
against that,
kind of posted a meme kind of shooting that down.
Right, exactly. But regardless, this is sort of all of a piece with what he has been doing as of late, right? Also is re-domiciling Tesla, right? And even though it's registered in Delaware, he's talking about now re-registering that in Texas. So this is a trend that we have seen. So we'll see how quickly he does it and what shareholders have to say about it. Although SpaceX and X, that's not relevant, I guess. All right, gold getting lifted to a record high amid rising rate cut hopes. However, despite the high rate environment, the precious metal has soared nearly 20% this year. For more on the runway ahead for gold, we've got Bill Baruch, Blue Line Futures president. Bill, it's interesting here because, on the one hand, we see so-called digital gold, crypto, Bitcoin surging, but that's more because a Trump administration is seen as being more favorable to it. Gold is just gold, as it's seen as a haven. So what is going on here? Explain it to us.
I mean, you're getting some that haven as some economic data has begun to deteriorate. I think the latest push on the heels of the CPI data that did show a little bit of disinflation. Now, I think too, as the Fed is being priced in to cut rates, I've been saying 3 cuts pretty much all year, and you're starting to see that third cut appear with a better than 50% probability. Once they start to cut, they typically kind of stay at it, and gold has averaged a 6% return within the first 30 days of a Fed cut. So I think we're starting to see maybe some of that pulled forward a bit. But listen, with Trump probabilities of taking the White House improving and becoming the favorite, some of the policy we could see is trying to weaken the dollar. And if that's the case, gold is priced in U.S. dollars, and at least the way we're looking at it, and that would increase the price. So I think that's also a tailwind, maybe a tailwind for Bitcoin, but I think it's also a tailwind for gold right now.
Can I ask you, Bill, I'm just curious, we're talking about the metal. What do you see with the miners as well?
Listen, the miners are trading at 2-year highs. I mean, they're really starting to move pretty nicely. I'm liking what we're seeing in the mining space to what the energy space saw in 2021, the summer of 2021, when crude oil finally got back above $70. A lot of the energy names were really lagging. And once they woke up, I mean, it's been a terrific move across the energy space and the names over the last couple of years. And I think that we're about the onset of that time now. It's finally kind of coming out of the doldrums. The mining stocks are waking up, and there really could be a long-lasting bull market at the moment.
Bill, one of the other things you've been watching is the ratio of gold to silver here. And so we have a chart of that as well. And largely, we have seen gold sort of outperforming for most of the year here. What is that? How do you look at them relative to each other, and what does that tell you?
Yeah, that gold chart is gold with silver as the denominator. So as silver improves at a faster pace than gold, you're going to see that chart show weakness. And that's actually a good thing for gold and silver because, when silver is woken up and it maybe not leading, but when it's trading well, that's really bullish for the complex. Over the past few days, we've seen gold diverge a bit and take the strength, and that's why we've seen that chart kind of rebound. Now, within that breakdown in May is when silver tested $33. Ultimately, silver's really trading on a lag to gold more than anything. I mean, it's had that rush of above 30 where it tested 33 early part of May. But I think silver should be trading $35 to $40 with gold, what it's doing. So there could be a bit of a catch-up trade here. And that's really how they work best, is when they're working together. So if silver can really wake up a bit and play a little bit of catch up, get to $35. We have at that point would certainly have a clear breakout of gold. And some of my technicals looking back at this decade-long consolidation in gold can really say that gold should be testing $2,800, $2,900 when this move is said and done.
Bill, we're talking about different variables affecting the metals here. What about seasonality, Bill? Is this generally, typically a supportive time for metals?
Yeah, absolutely. I mean, you look at the prior month finishing up in June is sometimes a lagging time for metals, and they don't perform. But when the onset of July takes place, it's usually game on, and we can see really strength into the autumn. And I think that's something that we've begun to see in the precious metals. But you look more industrial, copper hasn't performed very well. It's really struggled. Some of the others like platinum and palladium, certainly aluminum is looking pretty ugly right now. I think they all can turn. One of the reasons why the more industrial space has lagged is look at Chinese GDP. Earlier this week on Sunday night, U.S. time, we saw Chinese GDP miss expectations, and the Chinese yuan has continued to weaken against the U.S. dollar. It's certainly sort of exporting deflation from China in a sense, and that weighs on the metals. Specifically the industrial metals, which also more than 50% of silver's use is now industrial. And although it is a precious metal and follows gold, copper has fallen pretty sharply from where it was about 2 months ago, a month and a half ago. And right now that's been weighing on silver relative to gold.
Bill, always great to have you on the show. Thanks so much for making time for us.
Thank you. Thanks for having me.
Well, calling all streaming bulls, Netflix is set to report results Thursday after the close, and Wall Street's expectations are high. Analysts at Bank of America, Morgan Stanley, MoffettNathanson, they've all raised their price targets on the streaming giant just yesterday ahead of the print. Joining us now is Geeta Raghunathan, Bloomberg Intelligence senior media analyst, to talk to us about what to expect from Netflix. And Geeta, those shares have been performing well. They're up about 35% this year, so there is that optimism going into the print. What numbers are you watching most closely, and do you think Netflix is going to meet those high expectations?
Yeah, expectations definitely very, very high, Julie. And I think what is really ironic, though, is, they are actually trying to move away from subscriber numbers. They said that they're going to stop disclosing subscriber metrics altogether starting in the first quarter of 2025. But I think all of this optimism that we're seeing kind of heading into the second quarter earnings is actually off of subscriber numbers. So we know that they reported really high subscriber growth in the first quarter, 9.3 million new subscriber adds. And while the consensus for the second quarter is around 4.7 million, I think the street very much expects something much higher, maybe something to the tune of 6 to 7 million. And I think what's going to be even more interesting is if we see 2024 actually come out as one of the record years for net new subscriber ads for Netflix. I think right now, the way that they're going, they could very well report close to almost 30 million new subscriber gains just in 2024, which will be one of their highest ever outside of course, COVID.
And Geeta, there's also going to be a lot of focus, of course, on the ad tier. What do you expect we're going to hear from there?
Yeah, so far, it looks like the momentum with advertising, of course, it's kind of been a little bit slower than what we'd anticipated. So one of the numbers that they did disclose, Josh, at their upfront was, which was held in May, was that they have about 40 million active users, monthly active users. We don't know exactly how many subscribers they have because they haven't disclosed that publicly, but we estimate that it's close to about 20 million subscribers. But again, what they're doing right now is, while they haven't actually given us an ad number in terms of the amount of revenue that it's generating, they are introducing a lot of programming that is kind of going to be very, very appealing to advertisers. So, some of the deals that they've done include WWE, which they're going to start streaming starting in 2025. But much more important than that is the 2 NFL games that they're going to have on Christmas Day, which is going to be super, super appealing to advertisers. And we think it's going to be a big bump for their ad business.
Geeta, Nielsen was just out with its monthly numbers on streaming traffic, and I thought that some of the stuff was really interesting here. Netflix saw the biggest increase in market share, but its still overall share in June was lower than that of YouTube, which we don't tend to talk as much about because it's not a pure play. But I'm curious how you're thinking about competition for Netflix, or sort of where its weaknesses are at this point.
So in terms of that's a great point, Julie. So I think in terms of streaming competition. I think at this point it's safe to say that Netflix has pretty much won the streaming wars. Of course, we talk about YouTube, but that's a little bit of a different animal. I mean, that's a lot of user-generated content, and it's going to kind of be hard to get, the level of eyeballs. Obviously, they have 2 billion viewers that they reach every day, so it's on a completely different scale. But I think what's really positive for Netflix is that they still have only less than 10% of total TV viewing time. And if you kind of just look at their catalog, it has really, really broad appeal. And the one metric that we really look at when it comes to Netflix and when it comes to all streaming players is engagement. And engagement is very, very high for Netflix. It's higher than almost all of its other competitors. We're seeing 2.5 hours spent on average per day by a user. And we've seen that across the board. Even if you look at some of their biggest performing titles in 2Q, you look at Bridgerton, about 1 billion hours streamed of just that one title alone in 2Q. So we're seeing engagement numbers that are extremely strong. So when we kind of think about the competitive landscape, I think Netflix is in the best position that it's ever been competitively and also financially as well as fundamentally. So they're really firing here on all cylinders.
Geetha, you think price increases could be on the way? I know that's a bet some analysts on the street are making.
They haven't raised prices, Josh, for about 2 years now in the U.S. on their standard tier. It's been stuck at about $15.50. So they're absolutely due for a price increase. The reason they didn't do that is because they were introducing 2 new initiatives. One was that password sharing crackdown. The other was the advertising tier. So they obviously didn't want to rock the boat then. But, all of their competitors have raised prices. We definitely think they will raise prices a little bit later this year.
All right, Netflix earnings Thursday. We'll be watching. I know you will as well, Geetha. Thanks for joining us.
Thank you.
And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.
There's the closing bell on Wall Street. Now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended up, and we got some superlatives for you. The Dow at a record close here today. The winner among the big three averages, up 1.9%. That's about 743 points here to close at a record 40,955. But the S&P 500 says, okay, wait a minute, me too, up about 2/3% here, and its 38th record close of the year. As Jared just told us a few moments ago, it also touched an intraday record for the S&P. The Nasdaq, though, not joining that party today, but it is rising about 1/5 of 1%. It is the laggard in today's session. Jared and I have been watching very closely the gap between the major averages and the Russell. And the Russell 2000 of small caps definitely outperforming today with a 3.4% gain. The S&P equal weight is also outperforming today, the S&P 500, that is, with a 1.7% gain. So, Jared, it looks like this rally, this rotation that we've been talking about, that is continuing to happen and the rally continuing to broaden.
Oh, my goodness. Is it ever? Those small caps, let's just put it back on the Russell 2000 here behind me. This is what happened today. That's up 3.34%. We've had multiple 3% days plus over the last few days. Here's the 5-day total, up 11.38%. I'm going to show you the NASDAQ. That's barely positive there. That spread of 11 percentage points, that is one of the highest ever. And in fact, the Russell 2000 is now more extended than the S&P 500 in, I'm going to give the answer to that question in about 30 minutes. I'm going to cover that with Josh. Before then, I just want to tell you, industrials are really taking the leadership position today. They're up 2.5%, followed by another cyclical sector, that is materials. That's up almost 2%. Then you have consumer discretionary. Then you have healthcare. Then you have financials, real estate. Only tech underperforming today, only tech in the red, actually. And here in the NASDAQ, you can see exactly what's going on. Look at that mess to the left side of your screen. Look at all those red names, those mega caps in the red. NVIDIA down 1.6%, Alphabet down 1.4%. But the most of the selling was really limited to those big names. And if you take a look at the leaders here, you also see at the very bottom, we got the Mag 7 ETF. That's in the red. New York FANG, we know what that is, the FANG trade, and KWEB, which is a China trade. That has not been doing well, but basically everything else in the U.S. besides the Mag 7 doing extremely well. Home builders have really just been flying since last 30. So has regional banks, so has solar, so has unprofitable tech. And just take a look at this picture here. Here's the ARC Innovation Holdings. I'm going to show you over the last 5 days what a stark contrast. So small definitely coming into the fore here, Josh.
All right, Jared, thank you. For more on the markets, we're joined now by Drew Pettit, City Director of U.S. Equity Strategy. Drew, it is good to see you. So stocks hitting all-time highs. You just heard Jared there talk about money rotating into the small caps. What do you make of that rotation, Drew?
Look, I think this is the ultimate soft landing trade. We've said this for the better part of a year now. For small cap to really work, you have to have confidence in economic growth. And we had that this morning with retail sales. And you have to have confidence that the Fed is going to pivot and rates are going to move lower. And I think the CPI print last week really started kicking this off. So honestly, it seems to us like it's a big repositioning move, and it's just gaining steam the last few days.
You guys, in your mid-year outlook, raised your target for the S&P 500 to 5,600. We blew through that. We're already higher than that on that average. But you say in a bull case, you could see 6,000. Is that what's playing out right now? Are we going to see 6,000?
I think for us to really get there and make that our base case, not just our bullish upside case, you have to have the earnings follow through. So right now, we think the S&P is going to have 250 in earnings this year. That's slightly above bottom-up consensus right now. For us to get to that 6,000 magic number, I think you need to see 260 in earnings. For that to happen, you need the Mag 7 to continue to beat and raise, and you're going to have to see the rest of the index do that as well, which hasn't been the case year to date so far.
Drew, you mentioned the Mag 7. You know, what, for viewers who are listening right now, what's your advice on what to do with those names, Drew, which have enjoyed, of course, some very strong runs?
Yeah, look, we talk a lot about this in our thematic work and our focus on AI as of late. Anytime you see stocks rip and really go almost parabolic on the stock charts, that's a great opportunity to pocket some of those gains and redistribute it into other really good structural stories. Like, honestly, I think financials look really attractive here from a sector perspective. I think consumers been beaten up a lot, so there's opportunity there. So you can really barbell this and use some of these growth names, the Mag 7 profits that you're making, to fund the other side of the trade and to fund the value side of the market as well.
Drew, I want to dig into the AI side of the trade a little bit more here, because it sounds like what you're saying is not necessarily to exit those, but to pull back, take some profits there. How much of a believer are you still in the AI story? Because there have been some questions recently from some of your competitors about that narrative.
See, I think anytime there's new technology, it probably scares us. It gets hard to forecast fundamentally. But right now, when we look at the momentum, the earnings momentum behind a lot of the stocks in the AI trade, it's really strong. I think we can see that. I think that differentiates that, the current AI rally from the tech bubble we saw. There are fundamentals behind this right now. So we have a lot of conviction. AI remains a top theme to us. But anytime prices move too fast and make us uncomfortable, that's a great time to think about broadening your AI exposure from the enablers and the chip stocks to some of the potential users of the technology that the market's just getting to right now.
Drew, I'm curious to get some economic data in front of you too, because we got June retail sales this morning, Drew. That data came in better than expected. I'm curious just to get your take on that, Drew, and overall, where are you with the American consumer right now?
You know, it's funny. We've actually been a little bit more bullish than our economists when it comes to earnings relative to their macro and economic forecast. And when we start looking at consumer stocks, people have still been spending. It's just on what? Experiences over things has been really popular. E-commerce still taking share, still has really strong gains. And something like digital leisure. I know you were just talking about that with another analyst on the stock right before I came on, but those themes have been working in consumer. And now with rates potentially moving lower, now you can start to see a broadening out of that consumer trade rather than a few themes that have some structural longevity to them.
So where in consumer do you think is most ripe then? Is it sort of traditional retailer, or are you thinking more broadly than that?
Little bit of a barbell, to be honest with you. I think some discounters and some companies that have made massive changes and really invested on the digital side of their business get interesting. And then on the flip side, more of the experiences, again, like there are cruise lines, there are airlines that are still doing really well, can still push price, and people are still buying there. So again, experiences and self-help stories, if I was to really boil it down.
All right, lots of good ideas for people. Thanks a lot, Drew. Good to see you.
Oh, thanks for having me.
Coming up, data showing that home builders are feeling worse about the housing market. We'll have more on that when Market Domination Overtime returns.
Welcome to Stocks in Translation.
I'm almost always of the school that you buy high, sell higher.
Our essential conversation cutting through the hyperboles.
When the horse gets out of the barn, you have to go chase it.
The market mayhem.
You know, are you bullish or are you bearish? What is your target?
And the noisy numbers.
Don't fight Papa Dow.
Time now for our word of the day. This episode happens to be brought to us by the number 2. Eddie, who is wearing the DeFi mantra better? Is it Solana or Cardano? To give you the information you need for your portfolio.
There are a lot of ways to invest where you don't have to extend yourself and try to hit that home run.
You're going to find that technology was a leader and an outperformer in pretty much every single one of them.
Do we get the follow-on participation?
That's the big question, and maybe Jay Powell will help us with the little rate cut.
Watch Stocks in Translation here on Yahoo Finance at noon on Tuesdays and Thursdays, and listen to us on Apple, Spotify, iHeartRadio, or wherever you get your podcasts.
Data out today shows that homebuilder sentiment has fallen to its lowest level since December amid high mortgage rates. Yahoo Finance's Danny Romero joined us now with more. It's so interesting, Danny, because we got this at the same time that homebuilder stocks are rallying on the expectation that rates are going to be cut. So it's an interesting day to get this reading.
I mean, we have to remember that this home builder sentiment that we're getting is taking private home builders. We have to factor that in. It's the smaller private home builders, but they're not feeling confident about the housing market, especially as mortgage rates remain persistently high. The National Association of Home Builders reported that their housing market index fell to 42 points. That is the lowest reading since December. Remember, any number under 50 points indicates that viewers view conditions poor rather than good. But one thing that really stood out to me from this report that I would say is a positive is that the sales expectations for the next 6 months actually increased, signaling that there could be a recovery in the housing market. Meanwhile, investors are about to find out how publicly traded home builders have weathered the storm of high interest rates in their second quarter earnings. Some home builders like Taylor Morrison are set to report next week. But an analyst at B.R. Riley Securities says that the focus will less likely be on the quarterly results, but rather on the Fed rate cuts, which would be favorable for home builder profits. Julie?
Danny, quick one here. President Joe Biden making headlines this week, unveiling that series of proposals aimed at lowering housing costs. What more can you tell us about that news?
President Joe Biden is sending a message to American families that he wants to lower housing costs for families. Biden's plan would eliminate tax credits from landlords who increase their tenants' rent by 5% a year. Now, it would only impact landlords that have 50 units or more, which represents nearly half of all rental properties across the country. Now, this does not impact units that are under construction, but again, remember, this still needs congressional approval in order to get into effect. But again, some industry experts, such as Jason Furman, Obama's administrator's top economic advisor, he says that rent control would actually impact the housing supply negatively and not make it better, but make it worse, because he says it discourages new developments from being built. Bottom line, though, the timing on all of this is really interesting, especially as we go into an election year. Josh?
All right, Danny, thank you so much. We're taking a look at the AI economy and investing in infrastructure boom surrounding the industry. Smart Global Holdings, which designs, builds, and manages AI and high-performance computing infrastructure, announcing it secured a $200 million investment from SK Telecom. The company also announcing it plans to change the company name to Penguin Solutions, which is its biggest brand. Joining us now is Mark Adams, SGH CEO. Mark, good to see you.
Great, thanks for having me.
So maybe start on that news, Mark. This news that you all making like a $200 million strategic investment from SK Telecom. How has that news come about? What's going to mean for your business, Mark?
Well, I think if you look at what we've done very well over the last couple of decades is we got to understand the infrastructure environment and high performance computing. Penguin's been around for about 25 years. And if you think it really couldn't be a better precursor to AI than HPC, because you start with cooling systems and power, processors, memory, storage, networking, management software. And those are all things we do very, very well, in addition to our professional services that actually deploy these systems. And so SK Telecom is part of SK Group, which is the second largest conglomerate in Korea, $250 billion market cap. And they have extensive networking capabilities, processor capabilities, memory with their division SK Hynix. And so they complement what we're all about. And when you think about the last mile of integrating this type of technology, make it all work, it's a really interesting partnership for us on a global basis, because obviously they're very strong internationally.
So talk to us a little bit more about where you sit then. Do you sit in the last mile then of what we're talking about? Because I know your business is made up of memory in part, LED lighting solutions also, and then the biggest chunk of your business is what you call intelligent platform solutions.
Correct.
So for people who are not familiar, tell them what that means and how these different pieces are integrated.
So when you think about implementing AI today, all those technologies I just talked about are super complex. For example, we last year deployed the world's first oil-based immersion cooling. What does that mean? We literally put computers inside of recycled oil inside of a tank for efficiency use and power and actually environmental friendliness. That's just an example of one technology. Advanced compute technology with memory interconnecting with high bandwidth opportunities to increase the performance of GPUs, another good example. Then we have a layer of software on top of it that manages all the environment, knows when predictive stuff is going down as far as fault identification and repair, scheduling and provisioning. And so we have this host of solutions that actually makes the deployment piece pretty seamless for us, and that we're really good at that.
Mark, I was talking to an analyst who knows the company and the industry, and I was saying, well, who are their rivals? And he mentioned names, like he said, I'd put Dell there, I'd put HPE there. I mean, those are big names, Mark.
Sure.
I mean, how do you compete there? What are your competitive advantages?
Well, the competitive advantages, what I'm referring to is that kind of software service layer. The company's names you just mentioned are traditionally more hardware focused. And if you look at the margin profile of their business and our business, it's just different. By the way, and they're partners of ours. So it's not bad or good. It's just, our gross margin is substantially higher because we play in more of a service and software part of the solution. We do have systems, but we also can sell our products on Dell and HP and other systems.
What is this Gen AI enthusiasm going to mean for your business? Because you guys are also considerably smaller than some of those names that he just mentioned.
Yeah.
Are we going to start to see growth really ramp up for you guys as well as we've got all this demand for Gen AI?
I think that's where we're at. Actually, I think I've said in kind of prior earnings calls is that 23 and 24 were kind of the years of GPU sales. Everyone was like, GPUs getting sold off everywhere. Well, now they have to deploy them, and there's so little deployment yet really in corporate enterprise today. The hyperscalers, sure, and we've got one of those as our biggest customer. But if you look at traditional Fortune 500 enterprises, they're all kind of doing proof of concept, but they're not quite sure what AI is going to do. Now we're in that deployment phase, and that's going to benefit us. We feel really in a good way.
What percentage of your business, Mark, would you say now is AI related?
If you factor in where we're going with memory, it's kind of 2/3 or above, and it's going to grow more and more that way.
And what was it, versus,
when I started, when I took over the CEO job back in August of 20, it was 78%, 77% memory, and very little compute.
And as those companies start to figure out what proof of concept is, what's your feeling in terms of the broader economic environment and spending environment on the part of potential clients? What's their appetite for spending right now?
Well, I think the appetite's amazing just because boards are saying, hey, what is your AI strategy, right? And so companies are trying to define this on the fly because the game's happening. I think what's really encouraging for all the ecosystem players is that in these large language models, the number of parameters that run these models are going to like triple, quadruple, and so from that perspective, the amount of compute resources and data center resources are going to be substantial. What's interesting right now in the data center space is there's not enough of them with AI power. There's not enough megawatts, so there's a constraint right now on data centers that are enabled to drive AI, and so that's providing a lot of motivation for people to make that investment. So I think it's pretty favorable from an investment standpoint on the infrastructure piece.
What about, Mark, I'm just thinking about customers. How about crypto miners? Just given all the hardware they buy, is that a natural customer for you all?
It's funny you say that. The answer is absolutely yes, because we have looked at that space for a long time, and given the supply challenges around what I just said in terms of data centers, these people have immense amount of power, and the crypto business is pretty volatile. So if you look at some of the bigger crypto companies that are public companies, they've all announced an AI strategy, and yet they don't necessarily have the experience of 25 years of doing this type of infrastructure. They're great customers. We announced one today at our Analyst Day. It was our first ever software and services non-hardware deal with a company called Voltage Park, which is a tier 2 cloud service provider. We're installing 24,000, something like that, 24,000 GPUs in 4 data centers with them. Massive deployment, and they're converting their business from a prior model. That's true with other crypto players. That's really an interesting point you make.
There was a note out from economists and researchers at Goldman Sachs earlier this week that said, maybe Gen AI isn't going to be as big as we're thinking it is, because if you look at it, to your point, it being deployed in enterprises, it's hardly a blip at this point, and maybe it's not going to get there. They're not going to figure out what the use cases are. It doesn't sound like, though, you're seeing that necessarily in your business. Are you still confident that trajectory is still going to happen as predicted?
Well, I mean, there's two pieces of that question, the way I interpret it. The capital markets, there's just been some irrational valuations going on. And we're an operating company. We make money, we strengthen our balance sheet, what have you. And so we're a little more boring that way. But I think both the answers could be true. I think there's a lot of growth from here because people now are starting to think about how to deploy it. Now the question is the upside of how much growth that is. That's a hard one to call. I just think where people are struggling in the enterprise right now is, okay, I get what the technology can do, but what's it mean to me? Like the classic case study right now is ad revenue. So when we do these searches and people track us, and the next day these ads show up and they're the same ads we're looking at yesterday, okay. So, but if you're in healthcare, if you're in some other business, what's the kind of commercial value you're driving from an AI strategy? And I think that's the stage we're in is, okay, we understand the technology, how does it commercially become viable to give us an advantage in our business? And that's what we're seeing our customers to spend a lot of time on.
Yeah, try to figure out. All right, Mark, thank you so much for coming in. Really good to talk to you. Appreciate it.
Time now for What to Watch Wednesday, July 17th, starting off on the earnings front. We're getting a new round of reporting tomorrow from United Airlines, ASML, Johnson & Johnson, and Prologis, among others. United Airlines announcing results for the second quarter. Analysts expecting higher wages and fuel costs to weigh on the airline's Q2 earnings. We'll also get another batch of bank earnings, including U.S. Bancorp, Discover, and Citizens.
And moving over to housing, monthly numbers for housing starts and building permits are out in the morning, both expected to tick up slightly. Economists forecasting housing starts to be 1.3 million and building permits to be 1.4 million. Also due out tomorrow, weekly mortgage application data.
And finally, looking at the Fed, more Fed commentary coming in the morning from Richmond Fed President Tom Barkin and Fed Governor Christopher Waller. Fed Chair Jerome Powell signaling yesterday that the central bank is nearing the time when it can start cutting rates, and traders are becoming increasingly optimistic about a September cut.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. We've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will impact your bottom line long after the presidential polls have closed.
Our bottom line, it's still the economy, people.
We've got team coverage from New York to Los Angeles, but we start right here in Washington, D.C.
You can catch Capital Gains on all your favorite podcast and streaming platforms. You can't afford to miss it.
Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Another record day. The Dow rallying 700 points for its best day in more than a year. And the small cap Russell 2000 closes up 3%. Bitcoin's gains were far more muted from its Monday surge as investors upped the odds of a crypto-friendly Trump presidency. But the broadening market rally aside, AI still one of the hottest trades on Wall Street. Server storage company Super Microcomputer, which has rallied more than 200% in the past year, is set to replace Walgreens in the NASDAQ 100 index later this month. We're going to hear from the CEO later this hour. And get those carts ready. It's Prime Day, Amazon's two-day shopping bonanza kicking off in a show of dominance for the e-commerce giant. Shoppers are focused on deals, but investors will look to Amazon's growth and margins during the event. We're going to take a closer look in our chart of the day. Donald Trump affirming he will speak as scheduled at a Bitcoin conference coming up later this month. That's after an assassination attempt over the weekend. But the former president's support of cryptocurrency is relatively new. Trump was previously deemed it a scam when he was in the White House, but now the 2024 hopefully is singing a very different tune thanks to the efforts of crypto industry insiders. And joining me now is David Bailey, BTC Inc. CEO and organizer of the Bitcoin conference. David, it is good to have you back on the show. So Trump's going to be participating in the Bitcoin conference, David. That's July 27th. How did that come about, David?
Well, first off, Josh, thank you for having me back on the show. And yeah, we're thrilled to have the president speaking in what is going to be a historic speech on Bitcoin policy and his agenda as of the new administration. We've been working with the Trump campaign for several months, advising them on different policy platform items that our industry cares about, our community cares about, and really helping lay the case for the amount of votes and the amount of dollars that our industry can deliver for the campaign. So we've been very thankful for their support. Donald Trump is a businessman first and foremost, and he sees a good opportunity. And Bitcoin is the greatest opportunity for this country. So we're very thankful to be partnered with him.
And Dave, we know Trump wasn't always a fan of crypto. What changed there, David? Is it what you suggested there? Is it just, has it come down to dollars and votes?
Yeah, I mean, I think for most people, they don't start as a fan of Bitcoin. Most people, when they hear about Bitcoin, they think it's a scam. That's how I got started in Bitcoin. That's how Michael Saylor got started in Bitcoin. In fact, Michael Saylor's first tweet on the topic is, once the government figures this out, they're going to shut this down. So I think, the biggest advocates of Bitcoin start as the biggest skeptics. And then, they go through a journey where they come to understand the technology better. They come to interact with it more. And eventually what seems like a scam at first eventually kind of hits home as fundamentally innovation that's transformative.
And David, I know you're a fan of Trump. And from what I've read, you're going to be hosting a fundraiser for him in Nashville. Any concern, though, David, that, we're sitting here in July and Trump and Vance don't win in November, that Biden does? Any worries you would have that, maybe you put all your eggs here in one political basket?
Well, we are running a fundraiser for the president in Nashville. We want it to be a record-breaking fundraiser. So we're working around the clock. I've been on phone calls all day for about 2 weeks straight, raising money for the president. So we are eager to show him what our industry is able to deliver and show him how much we care about this topic. Our industry considers ourselves single issue voters, meaning that, your policy on Bitcoin is what's going to determine how we show up to the ballot box. To your question about, are we worried about putting all of our eggs in one basket? The way the Biden administration has treated the Bitcoin and crypto community has been horrendous.
And what do you mean by that, David, when you say horrendous?
They have had the SEC give awful guidance, jail or prosecute legitimate businessmen and entrepreneurs that are trying to build great technology businesses in the United States. They've suggested tax regimes for our industry that, if implemented, would devastate the American Bitcoin industry. They've targeted Bitcoin miners, claiming that they are fundamentally dangerous to the environment, when in fact Bitcoin miners are investing billions of dollars into America's infrastructure and energy infrastructure. The list goes on. The president actually just vetoed a bill that would have given U.S. financial institutions the ability to custody digital assets on their balance sheet. And so, he's holding back our industry in the United States, and he's giving other nations a massive competitive advantage over the states. So
Just to play devil's advocate, could someone counter and give me your take on this? But at the end of the day, spot Bitcoin ETFs got the green light. Reportedly, you probably saw this, David. Spot Ether ETFs are on the way. What do you say to that?
We had to sue the SEC and do a multi-year fight against the SEC to get there. The spot ETFs should have been approved 5 years ago. So, if there's one thing I would say I wish Trump had done differently in his last administration, he should have approved the spot ETFs. And so it's been a nonstop fist fight with the Biden administration. And so, frankly, at this point, we feel like we don't have much to lose. And what we hope is that by showing up for the Trump administration, and let me be clear, Bitcoin is bipartisan. Bitcoin is a technology, it's a tool. It does not have a political leaning or a prescribed political faction. But if you're going to come after our industry, then our industry is going to defend itself. And so what we hope is that by showing up big for the President Trump, by helping him win the White House, we're going to send a message to the Democratic Party that they're on the wrong side of this issue, and that it would be much more productive for them to work with our industry rather than to banish our industry. There are over 50 million Americans that own Bitcoin and other cryptocurrencies. That is a massive voter block. And there used to be an old political adage that people vote their pocketbook. Bitcoin is people's pocketbooks today. So the Democratic Party is misaligned with the public, and we're hoping that by making ourselves heard in this election, we'll make ourselves heard in all the future elections as well.
It is impressive, David, the way crypto has become an issue in this campaign, in this election. We always appreciate you coming on the show, David. Thanks so much.
Thank you for having me.
The S&P 500 and Dow closed at a fresh record high with small caps shining bright. Yahoo Finance's Jared Blickry joins us now with the takeaways of the trading day. Jared.
Josh, small caps are on fire. We have never had a 5-day period where small caps outperform large caps. And I'm talking about the Russell 2000 versus the S&P 500. We have never had that ever. And I'm going to show you a comparison. This is the Russell 2000 versus the NASDAQ 100 over the last 5 days. You'll notice that the NASDAQ 100 is negative, whereas the Russell 2000 up 11.5%. This just does not happen that often. I really want to underscore that. And it's not just the small caps, it's also the smaller large caps. So you talk about the S&P 500 versus the 495. This is the S&P 500, which is up 1.5 points. But you compare it to its equal cap, that's where everything gets an equal vote, that is up almost 5%. So just a huge breakout by small caps here.
So small caps, so we're waiting for them to work. We're waiting for them to work.
Yes.
Now they are working. Now I have to ask you, technicals, let's look at the chart. I mean, do they now look, actually, the small caps look overextended now?
That's a decent point. That's a fair point to raise. I was talking about the last 5 days. You look at this, up 11.5%. That's a big amount. So yes, I think temporarily you might see a little bit of a slowdown, but this is a 5-year chart. So that's a pandemic mess in there. What's happened is small caps just recently broke out of this multi-year base. And so this tends to get momentum. Now, what usually happens, what I would expect to happen is maybe we do come back a little bit, but that prior resistance should now act as support. And that's how you gauge the health of the new trend.
All right, next, Jared, point number 2.
All right, I'm on pins and needle here too. Let's see what we got. Oh, by the way, I just want small caps. I forgot to show this chart. This is coming off the worst 6 months performance ever. And that's relative to the S&P 500. Wow. So just kind of underscores that. Cyclicals are surging. So what has been working? We talked about small caps, but you look at even the large cap sectors, industrials, materials only broke out within the last 5 to 10 trading days. And in fact, you look at the catalyst and you think about the catalyst in this market, a lot of that was last Thursday, but a lot of these trends started a day or two before. So over the last 5 days, we have industrials up 6%. Real estate, that's more of an interest rate story. materials, cyclical, finance more of a value sector there, energy value. But my point is, all of these fringe sectors which had been beaten down or which hadn't done much for a while, I shouldn't say beaten down, but hadn't done much for a while, finally perking up. Let's take a look at XHB. That's home builders up 16% over the last few days. Here's a 5-year chart, and you can see it was consolidating for much of 2024. You can see that in the year-to-date chart, and it just broke to the upside. Look at that. So, kind of back to your last pushback, this is a little bit too far, too fast, but when we take a look at where we expect it to go next, we might come down a little bit, but you want that prior resistance to become support.
We talked about small caps, bite-sized guys. What about Mag 7, big tech?
Mag 7 has not done that well over the last 5 days, and you can see this in the NASDAQ 100 chart, where we have Meta down about 7.6%, Amazon down 3%.
Look at Apple, though.
Apple kind of bucking the trend. And by the way, going back to 1980, Apple does really well in August. So, another few weeks, maybe set your clock to that.
I wonder, you think that's just people getting ready for Tim Cook to take the stage in September? Unveil those shiny new iPhones.
This goes back to Steve Jobs. This predates the iPhone. It predates everything. August, Apple. I don't know. Investors love it. But to your point, Mag 7 here, not doing so well. The mega caps, they had their day in the sun, but they've fallen off a little bit.
All right, rotation.
Yeah, you know what? That's exactly what it is. Don't give that short shrift. Sector rotation is the lifeblood of the bull market. All right, we want to take a look at seasonality.
Seasonality.
Oh yeah.
Again, there's been too long.
we've had so much bullish seasonality here. It's like a bullet. I've been showing this chart. This is the first 10 days of the month and the last 10 days of the month. This is what we just came out of. This was the first 10 days, business days, trading days of July, and it's over. And you can see the last 10 days, which is where we're heading into right now. Just a little bit of a blip. That's not negative. It's just not positive. So we might have seen a lot of stuff kind of get pulled into this seasonality here. And guess what? We don't see much happening until middle of August. That's looking at the S&P 500. We can also look at the VIX. Here's where we are with the VIX. Purple is what usually happens in an average year. This goes back to 1990, the beginning of the VIX. So what I'm looking for is that first spike up there. This happens at the beginning of August, and that's where I might expect to see a little bit of more volatility, maybe a little bit of a sell-off there. So second half of June, I'm not expecting too much in terms of seasonality plays, but at the beginning of August, I'm starting to see a little caution there.
All right, Jared. Thank you, my friend.
You bet.
Thank you. Still to come, we're going to hear from the CEO of Super Microcomputer as the company gears up to join the NASDAQ 100 index. Stay tuned. More asking for a trend on the other side. NASDAQ announcing the addition of supermicrocomputer to the NASDAQ 100 starting next week. Stock having a meteoric rise this year. It's up more than 200% year to date, even outperforming NVIDIA. And joining us now to talk about all this is Supermicrocomputer CEO Charles Liang. Charles, it is good to see you. So let's start with that news, Charles. You are joining the NASDAQ 100 starting July 22nd. Walk us through, Charles, just what this means as a milestone for you, the company, your employees.
Yeah, thank you, Josh. It's been a great honor, and we are very happy to be listed in NASDAQ Top 100 company. That also means the industry recognize our green computing, our time to market with new technology, and especially our liquid cooling recently, that really help customers reduce their energy cost, reduce carbon footprint, and make their data center available online earlier because of less power consumption. So it's a great honor, and we are very happy to continue grow our company in green computing, in optimized data center for AI.
And Charles, typically when a company is added to one of the indexes, we do see a little more upside as various ETFs and index funds add the stock. With your stock already up so much, what is the revenue and earnings growth that you are predicting? And has the stock gotten a little ahead of itself with the huge gains that it's seen?
Yeah, thank you for the question. Last 2 years, we have been growing a lot. Indeed, last year more than double. And I believe that strong growth will continue because the AI boom is just beginning. And people like our energy saving, like our building block solution for specific application optimized solution. So we are very happy for that, and company continue to accelerate our production capacity. Even in Silicon Valley, we just added 4 more new buildings recently. The demand is strong, and we are preparing to service the market quicker and better.
Charles, your stock has enjoyed just a remarkable run, but you do have competition, right? Dell, HPE, other server makers, these are big names. What is your competitive advantage, Charles?
Our advantage including technology time to market. When our vendor partner have a new chip, new architecture available, usually we are able to bring the optimized system to our customer earlier. And not just earlier, but with energy saving, with best optimization for performance, for easy maintenance. And we have customer on-site deployment, make the job easier for our customer so that they can bring new technology to online quicker as they want. So also our production in Silicon Valley, that has been another advantage. Customer work with us in our factory and validate, optimize everything. We make it rack scale, plug and play. So when we ship the rack to customer side, customer can go for online in a few days. So they are ready to be online in a few days. So that's some of our advantage compared with others.
I'm curious not just about competition for customers, but competition for the building blocks for your servers and your products. I'm talking about the chips, of course. Now, I know that you all have partnered with NVIDIA as sort of the building blocks for your servers, but are you getting the supply that you need to meet the demand that is out there right now? Because there's a lot of competition, not just for customers, but for the chips to build what you guys build.
Yeah, we are very lucky. Indeed, since day one, I founded the company in 1993. We designed our product, build our product based on building block solution. And after 31 years, refining, redesign, improving, indeed, it surprised myself. Our building block solution has been a very powerful tool that helps us design, manufacture new product, time to market quicker, and also with better quality, better cost structure, able to leverage inventory more efficiently, easy to support a customer on site. So it's an amazing architecture. And since day one, 31 years ago, again, I did not know the building block solution can be that powerful. So we are very lucky. We have a good architecture and a good partner to work together.
You know, a broader question for you, Charles. Some argue that they think about AI right now, and they argue we're really at this kind of historic moment. You know, you've heard NVIDIA's Jensen Huang talk about this, that, you know, Jensen will say, you know, the next industrial revolution has begun. That's how he describes it. Do you see it that way, Charles?
Yes, Jensen is like a genius, right? He has been have a very good vision, and we work with them very closely. So we believe, we both believe the AI boom is just beginning, and AI will continue to bring lots of advantage to human being, the society, make things more precise, more perfect, more efficient. Even more power saving, right? So improve people's life quality and improve people's education system, culture, I mean, in lots of areas. So we are very happy to work with the industry leader, continue to deliver the fully optimized solution to the market.
Charles, thank you so much for joining the show today. We appreciate your time.
Thank you, Josh and Julie. Thank you.
Amazon stock trades at 32 times estimated earnings, which is above the NASDAQ 100's multiple, but below Amazon's 10-year average. Yahoo Finance's Julie Hyman joins me now with a closer look.
Yeah, and this chart of the day prompted because it is Amazon Prime Day, or Prime Days, really, because it lasts 2 days here. And even though a lot of the reasons that people look at Amazon is not necessarily because of its retail business, it's because of things like AWS, for example, still it is a spur for some investors to take a look at the stock. JP Morgan, for example, estimates that gross merchandise volume, that is the total value of stuff sold on Amazon during its Prime days, rose by 12% this time around to about $12.4 billion. And he says a lot of that wouldn't have happened if it weren't for Prime Day and the deals that it spurs. So that brings me to the multiple here, the price to forward earnings. Now, Bloomberg puts it at around 32, 33 here, which is indeed higher than the NASDAQ 100s and higher than some of its competitors, but it is cheap on a historical level, as we have seen those shares rally this year by more than 25%. Earlier today, we heard from Gil Luria, an analyst who covers the stock, and he talked about sort of the proposition of why people would be looking at Amazon right now.
We actually think Amazon, at the end of the day, may have more AI business than any of these other companies. AWS is the biggest hyperscaler, and it's done a lot to catch up to Azure in terms of AI capabilities. And yet Amazon is getting very little credit in terms of multiple. It's trading at average multiple compared to its historical rates. And so we think that's where, when they get more credit, that stock will outperform.
And this at a time where the operating margin for Amazon is projected this year to be around 10%. That would be about double what it's been on average over the past 5 years, Josh.
All right, thank you, Julie. Now let's take a look at what's trending here after hours. Shares of Five Below sliding after the retailer announces a CEO transition and second quarter guidance. Joel Anderson stepping down as CEO and will be replaced by the company's COO, Kenneth Bull. The retailer also slashing its earnings guidance for the second quarter. Five Below now seeing earnings per share of 53 to 56 cents. That's down from the 57 to 69 cents previously forecasted. Company also expecting a sharper decline in same-store sales than earlier thought. Also watching shares of Spirit Airlines, the airline cutting its second quarter revenue guidance, and the company saying that's mostly a result of disappointing non-ticket revenue. It's guiding revenue to come in at roughly $1.28 billion. That news also weighing on shares of other airlines after hours, including JetBlue and Southwest. And turning to J.B. Hunt, shares of the transportation giant sliding after reporting second quarter earnings below Wall Street estimates. Revenue for the quarter also falling below expectations. Total operating revenue decreasing 7% compared to the prior year. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.